Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Nnamdi Iregbulem joins us today from San Francisco. Nnamdi is a partner at Lightspeed, a multi-stage firm with notable investments such as Snapchat, Affirm, and Carter, to name a few. Prior to Lightspeed, he was an investor at Iconic Capital, working on investments such as GitLab, Fastly, and Uber. Since joining Lightspeed, Nnamdi has led investments in Astro, Materialize, Polar Signals, and Vectorized. Nnamdi, welcome to the show.
Thanks. Great to be here.
Cool. So can you walk us through your background and path to venture?
Yeah, happy to. The quickest way of summarizing what I'm about is that I'm a massive technology nerd. I've been a self-taught programmer ever since I was a kid and always really loved software and technology, and always knew I wanted to contribute to it in some capacity, either by working or investing in tech. I've been mostly on the investing route for my career, but in terms of my evolution over time, started off building websites, often with PHP and WordPress as a kid, to building computers, to getting my first investing gig back at Iconic, where I started off as a journalist and then naturally gravitated towards enterprise software. And then within that, gravitated towards some of these areas that really excite me around developer productivity. So think developer tools, application infrastructure, data science, and machine learning. Had the opportunity to work with a bunch of really interesting companies. Then spent a little bit of time working in product at Confluent, the Apache Kafka company, and then came back to investing here at Lightspeed, where I focus on early stage companies in all those same areas that I mentioned. And so, developer productivity is what I'm obsessed about. Anything that can make the lives of technical people easier is interesting to me. And so that's kind of my prime motivator.
So what prompted you to leave Iconic to become a PM and then ultimately back to Lightspeed?
To be totally honest, I had always had the itch to try out the operating side. I was sort of that, although, in my early sort of investing career, the investing process involved all sorts of things from more qualitative to quantitative analysis. I tended to be the more like product and technically focused person, and always felt that, I could probably put those skills to better use. And then, once I had scratched that itch, I realized that by being an early stage investor, you can actually continue to scratch that itch. In the earliest stages, there's still a lot of product risk. There's still a lot of technical risk. And I think early stage founders really appreciate investors who actually understand the underpinnings of what they're building. And so I found it to be super synergistic with kind of my day-to-day work.
For those that aren't familiar with Lightspeed, can you give us a quick overview of the firm and your particular area of focus?
Yeah. So, Lightspeed at this point is a kind of multi-stage venture firm. We've been around for 20 plus years, initially with a focus on kind of enterprise, IT infrastructure, and have since expanded to other domains like, B2C, fintech, healthcare, crypto, and, the list goes on. We're also global with, operations and teams in many different countries at this point. And then specifically at Lightspeed, I focus on early stage investments, which you could very roughly define as seed, Series A, Series B companies, especially those with an emphasis on kind of technical tooling. And so I'm trying to partner with brilliant ex-engineers who are trying to build the future infrastructure systems that are going to support all the big iconic names that we hear about in the Valley. And that's what I focus on.
Got it. So we have a lot of topics that I want to get to today, but I would be remiss if I didn't start with the current environment that we're in. Can you describe what's causing the massive public drops that we're seeing?
Yeah, the simplest explanation is that there's been a change in expectations for future interest rates driven by, Federal Reserve behavior, which is driven by the inflation that we've been seeing over the last few quarters. The Fed obviously wants to keep a lid on inflation, and interest rates are their primary way to do that. But when they do that, that kind of kicks off a chain reaction through the rest of the economy, and interest rates and kind of expected return rates, rise across all asset classes effectively. And when interest rates go up or expected returns go up, asset values go down. And so that is sort of the core driver of the drop off in the markets that we've seen recently. And then in addition, this past quarter we had a negative GDP growth number. And so if you think that is likely to continue and the economy is likely to contract, that's also what's driving a lot of this market reaction. But the primary motivator thus far has been the interest rates.
And over the past couple of years, we've seen more capital deployed into venture than ever before. An unprecedented rate of unicorns being minted at extremely high revenue multiples. So with so many startups having raised these massive rounds and the macro environment being where it is today, how do you see all this unfolding? Do you think we're going to see other similar situations to that of Fast, or what do you see?
Yeah, it's sort of like there's an expression of like, you can't really tell what's there until the tide goes out, so to speak. The tide goes out and suddenly there's a bunch of things there that you didn't realize were there. And a lot of folks are left like high and dry. And I think that's effectively what we're going to start seeing. I think people sometimes forget that, the way Silicon Valley works for a lot of companies is that the success of the company is predicated on being able to continue to fundraise, because at any given point, the company isn't profitable and doesn't necessarily have a path to getting to break even on the money that it currently has. And so if suddenly that chain of financings is broken and a company does not have certainty that it's going to be able to raise its next round, it's pretty much forced to make pretty drastic changes in its plans, in its headcount, and the amount of burn that they're going to take on. And so that's what you're starting to see. In most cases, the companies that are doing layoffs right now, it's not that they are about to run out of cash. They have cash probably for maybe even 12 or more months, but they're not sure they're going to be able to fundraise in that time zone. And so that's why folks are reacting now as opposed to waiting till things become even more dire.
How are you advising companies today that you work with? Are you telling them to focus more on profitability or pay attention to growth and maybe grow more efficiently?
So, and I'll speak just for myself, given my areas of focus, because most of the companies I'm working with are still fairly early. In my case, it's probably too early to be worried about profitability, so to speak. And it's the more proximate thing to be worried about is just runway, in terms of how much runway do we have before we need to fundraise again. And so, I'm still, my companies are still mostly focused on growth, but doing that within the context of, again, the next fundraise being a bit more uncertain, and the terms upon which the company will be able to fundraise being, a lot more uncertain. And so those are the conversations that I'm having. But, other folks might be different.
Do you think the type of growth has changed at all? Would you say it's more efficient growth versus let's put more resources to work versus, all right, let's make, $1 return a higher multiple of revenue?
Totally. The first dollar of spend you cut is the least efficient one. And so that's what companies are trying to sort through right now. And you're seeing that both in private and in public companies. When capital has been cheap, folks have been maybe less discerning as far as how to spend their capital. And now that it's becoming more expensive, people are trying to find ways to kind of optimize ROI a bit more strictly than they have been these past few years. And so there's definitely a shift towards more efficient, higher quality growth. What exactly that means is going to be a little bit different for each company, but definitely noticing that for sure.
What do you think the long-term effect will be on the asset class across various stages?
Yeah, I sometimes, it's tricky because you never really know what the median or the mean sort of situation is the situation we're in now below the long-term average, like in terms of the environment, or is this the average? It's really hard to say. Did what we just go through, was that the average or was that above average? You never really know. My general sense is that this is going to be a temporary period of higher uncertainty and choppier markets, but that this will continue to be a great asset class from an investor standpoint, and a great kind of like economic growth engine from the perspective of founders looking to build interesting companies. So I'm hopeful, and I think Lightspeed is hopeful as well. But it's the immediate next 6 months to 24 months is definitely batten the hatches. Get your ships in order for sure.
Yeah, definitely. And one of the areas that's been especially hit hard in the public markets is SaaS companies. Yet many are still growing. And I'm curious from your perspective, is there a limit that these large SaaS companies are going to hit at some point?
Yes, but I think that limit is so far that it's not necessarily worth worrying about in the near term. The thing you have to worry about more in the near term is the adoption curve to that endpoint. The endpoint is still just as attractive as I think it's always been. But in tough economic times, enterprises cut spend, consumers cut spend, and if you think about like startups are usually targeting that most highly variable portion of spend by either enterprises or consumers. And so startups are kind of disproportionately impacted when the belt tightening happens versus like very, very, established companies. And so that's kind of the risk in startup land. If you're like a large scale, software company at this point, I think you have a pretty good business and you don't need to be sort of too worried. I think software penetration is only increasing and the long-term picture remains bright for that reason. So yeah.
And a slight sidestep here, but while on the topic of price, how has your own price sensitivity changed over the past couple of years? And with the current environment, where does it stand today?
It's a good question. Frankly, a lot of my investing career has been forged during these crazy times of the last 10 years. So I'm a little bit biased in thinking that, that was normal. And, I will certainly be readjusting my expectations to some extent, for this new period. I would say, venture is a tricky business because unlike public markets investing, where there's no pressure to invest if you don't think that the prices are right, you can just hold the money. And holding money, that is an asset in itself. And so you can mark yourself to the returns you hold on your cash in the worst case scenario. In venture, we don't have that luxury because we raise these funds and LPs commit this capital. So we have to deploy it on some timeline. And so sitting by on the sidelines and saying, well, the prices are too high, it's just not something you can do for very long. And so, our hand is a bit forced and has been a bit forced like this last decade. And so regardless of what I think about what prices make sense or not, you have to pay, you have to kind of participate. And so, that's been my mentality. But, let's just say I was not the most irrationally exuberant of most, relative to other market participants, to put it very diplomatically.
Fair enough. Prior to the call, we talked about the current SaaS juggernauts such as Adobe, Zoom, Shopify, etc., and whether or not future success stories will have similar models. Where do you stand on this? Would you advise founders to emulate their routes or try and take the road less traveled and forge a new path altogether?
It's tricky because on the one hand, if following Shopify's model, for example, was as easy as just deciding to follow Shopify's model, I would say, well, if you can execute the way they have in the run up until very recently, I would say go for it. That seems to have worked, and if you're capable of executing in that exceptional way, like good for you, you should do that. On the other hand, aside from that not necessarily being realistic for a lot of folks, I think the things that lead to success over time tend to change. Like the core doesn't change, but the tactics, the particular entry points, the particular openings in the market change over time. It's like that expression, like the next search, the next, Larry Page is going to start a search company. The next, Mark Zuckerberg is going to start a social network. It's like the entry point changes and it's never exactly the same. And so while I think there's a lot of inspiration to take from those companies that have worked out historically, in all likelihood, the opportunities that they exploited are no longer exploitable in the same way. And so you need to look for new openings. And so I'll look to them as like guidance for like excellence, like how to achieve excellence within, software and startups in general. But for your particular market opportunity, you're going to need to innovate. You're going to need to think a little bit, outside the box.
Are there any gaps in the market or business models that you're particularly excited about as of late?
It's that classic, like if I was that excited about it, I wouldn't tell you. If I really thought I was going to make a ton of money doing this, I just would not share it with anybody. But look, I think, as I mentioned, like software penetration is only increasing. And I'm always continuously shocked by, it's easy to be biased in the Valley and think like software is everywhere, but you go into other parts of the world, other parts of even just the US, and a lot of folks haven't seen the light, so to speak. A lot of the next gen tooling that we use in the Valley is just not proliferated in the same way through most enterprises. And so I continue to think that that's just a really interesting opportunity, outside of like, it's great to have a bunch of startup logos on your site to be able to say all the cool kids use our product, but there's like a whole bunch of people in places you haven't even heard of that would buy your software if only you were to pitch them on it. I think that still continues to be a very untapped opportunity. I think it's actually the advantage of companies that get founded outside of the Valley, like in places like, take like Utah, for example. I mean, there's lots of amazing companies that come out of Utah, and there's like a reason for that. I think people like underappreciate the richness of like that ecosystem, the number of companies that you can sell to if you just pick up the phone and call them. They may not have a Twitter account that you can DM, but there's someone with a phone number you can call, and you put an inside sales rep on the phone and he dials those numbers, he or she dials those numbers, and you can sell. It shocks me every time, but it's very true.
Has your position on the Bay Area changed over the last couple of years, or your time being an investor? You mentioned Salt Lake being an area where interesting companies are popping up, and Salt Lake's not alone. There are other areas that are growing quickly. Like, for example, Chicago today has more unicorns than the Bay Area did a decade ago. So we're starting to see many of these ecosystems come into their own. For you as an investor, are you starting to look more outside the Bay Area, or how do you think about this?
Yeah, so I'm funny in the sense that I was never that Bay Area focused in terms of my investing activities. I was just meeting interesting people wherever they happen to be. And so a lot of them did happen to be in the Bay Area historically. And so that's kind of naturally been a focus, but not purposeful. I think talent is everywhere. I think there's lots of interesting people in, lots of places. And so, I'm trying to kind of buck the trend a little bit and, spend time in some of these other geos. I think the biggest thing that's changed about the relative attractiveness of Silicon Valley versus others in the last few years is the fact that because you can now start a company remotely, the Bay Area doesn't need to be your home. It doesn't need to be your center of operations. You can hypothetically start a company anywhere. And some of these other geographies are actually really great if you don't need to have everybody there in person with you. The lower cost of living, oftentimes like a better regulatory situation, go down the list. And so a lot of founders are now sort of saying, they're looking at a longer list of potential places to call home for both themselves and their companies. If you do the power rankings, the Bay Area is still far and away the number one. But for folks who are a bit more agnostic, there's a lot of other interesting places. And so one definitely has to keep that in mind.
Mm-hmm. I'd be curious to go deeper on what you're typically looking for in an investment. Prior to the show, you said that you felt there aren't very many investable startups, despite all the new companies that are being started today. In your opinion, what makes a company investable, or how do you define an investable startup?
Yeah, and it's probably worth adding the qualifier of a venture investable startup. I think most companies are investable in the sense that there's someone who this is a good fit for, some investor who is a good fit for what you're trying to build. The question is like, what are you trying to build? And I kind of like I think it was like a Paul Graham definition for a startup, which in very sort of simple terms is just companies that want to grow very fast over, some period of time and, become a large company. And most companies that get started aren't trying to do that. And then even within companies that self-style themselves as startups, a lot of them don't necessarily have the kind of fat-tailed power law type outcome distribution that we as venture investors really have to invest into and have to underwrite to, because otherwise the math of the asset class just doesn't work. The valuations that we pay to get involved with these companies upon entry are just too high unless the companies are trying to build very large $1 billion plus companies. And I think sometimes a lot of perfectly well-meaning founders don't realize that when we say like you need to be swinging for the fences, you need to be swinging hard, and the fences are very far away. And so when I say that there aren't actually that many investable startups, that's kind of what I'm referring to. The actual number of startups out there that have the opportunity to produce venture scale outcomes, I think, is less than people think, despite all of the activity. And so in terms of like what I look for to kind of filter out like this subset of companies, one is like to what I just mentioned, like the founder ambition. Like, do they have the ambition to build this very large company? And it's totally fine if you don't. It's not everybody has to do this thing that we call startups, but that's an important filter. I think having, as I like to call, some amount of spikiness as a founder. So like you're not going to be perfect at everything, but is there some subset of things that you're just totally brilliant about, whether it's some technical skill you have, or you're amazing at selling, or you're amazing at hiring, or you're amazing at marketing, whatever it is, what are like the one or two things that you're just super strong on? Because those will help make up for all the things that you're maybe weaker on. That's another thing that I look for. And then like you evaluate the idea itself. And I think investors probably think too highly of their ability to evaluate ideas. Everybody has that long kind of anti-portfolio of companies they thought were not good ideas that turned out to work really, really well. And if anything, there's maybe a slight correlation between an idea sounding a little strange and actually working well. So I'm always humble about my ability to actually evaluate ideas. And I'm trying much more to kind of be about evaluating people actually. So those are some of the things that I think about.
How do you think, or why do you think investors miss so frequently on the idea itself?
I think it's funny because everybody in investing talks about power laws and fat tails and 80% of your companies go to zero and 20% make up for it. And people say all these things, but they don't actually fully play out the logic of what that implies. Because what it implies is that it's a very high variance dynamic where you want to invest in companies that are weird. Like you want to invest in companies that are somehow different from the norm. Like investing in normal stuff gets you normal distributions. You're not looking for normal distributions. You're looking for, these like power laws. And so you need to find things that do look a little bit strange, that like spike on some number of things and are maybe, not so great on other things. Because those are the things that actually have the potential to like get above the noise. And I think a lot of people just don't fully appreciate that. They think that they can model all the different variables and the parameters and evaluate an idea down to like some like level of precision. And I think that's just a joke. That it's not a thing. And so I think it's like a level of humility that you constantly need to kind of reinforce as an investor, and understand that like there's a reason you're an investor and they're the founder. It's because they're the ones with the great ideas for building the future, and you're not supposed to like don't think too highly of yourself as an investor.
So have you made investments then where your intuition about the concept or the idea, you weren't entirely sold, but you just believed in the founder and that was enough to make the bet?
Yeah, I mean, I would be lying if I said that I've invested in an idea that I thought was bad, but I thought the founder was amazing. I at least think that the idea is plausible, and that like the full plausibility I kind of leave to the founder. I kind of give them credit for that. But yes, totally, I've invested in companies and founders where the founder was just brilliant. And maybe I had some concerns about the idea, and you almost always do. But you sort of say, hey, this person's going to figure it out. And these uncertainties that we have right now are going to be kind of iterated on over time. And this person's just going to break through walls to figure this all out. Do that all the time.
Mm-hmm. So you're an active blogger. What's one piece of advice you'd give to younger VCs looking to develop their writing skills?
Yeah, it's everybody seems to think that VCs are super loud on Twitter, on social media, on blogs. They're like these like content marketing engines. But if you actually measure the proportion of VCs that do any of these things, it's actually quite low. The set of people that I think has evolved to become VCs over time has become, I think, a little bit of a too safety seeking. It's a lot of folks who did well in school and are smart people and don't want to buck the trend too much. And so the idea of like putting their thoughts out there online for the world to judge is oftentimes like extremely frightening, to the point where a lot of folks, if you talk to a lot of VCs, they have some draft of some blog post, their first blog post they ever wanted to publish, they just never did because they were never able to get over that kind of activation energy of putting themselves out there and being, judged for their work. And so my biggest piece of advice is like, as Nike says, just do it, like put it out there, get over yourself a little bit, understand that the dynamics are actually in your favor for writing and putting content out on the internet, because bad stuff generally doesn't get propagated. Only really the good stuff gets propagated. So if your stuff is bad, no one will ever see it. It'll just die on the vine. Whereas if your stuff, a lot of people see it, that almost definitionally means that it was good. And so this idea of being afraid of what people are going to think, I think is like way overblown. So I think keeping that logic in mind is super important. And then the other thing to keep in mind is that content is actually very similar to betting on startups. It's a very sort of power law thing. But, the downside is capped, like for the most part, unless you write something and you get canceled. But for the most part, the downside is capped and the upside is pretty high. I've seen amazing things happen to folks based off of something they've read. I've had amazing things happen to me based off of things that I've written. And so keep that in mind. It can seem like it's an 80% failure rate kind of thing. And frankly, it kind of is. But the 20% like more than make up for it. And so that's what I would say.
Has your writing been a source of deal flow for you? Have you had founders reach out due to one of them coming across one of your writings that they really respect?
Yeah, it happens all the time, actually. And it's hard to tie inputs to outputs in the sense of like founders don't always tell me that that's how they came across me, but it often happens. I had a founder who we didn't end up investing in them, but he's now been backed multiple times by some pretty exceptional investors who his original contact to me was a Twitter DM. And he was just like, hey, you seem like a data nerd. We're building this data analysis thing. Would love for you to try it out. I don't even think he realized that I was a VC. I think he just saw my writing and seemed like, oh, this is someone who speaks the same language. And then we got on the phone and he realized we were as a VC. And that's just kind of how it happened. And then oftentimes, maybe my first contact with a founder will be from my reaching out. But in the interim between our catch-ups, they'll come across some of my pieces, they'll read them, and they'll mention that to me the next time that I talk to them, which I always really appreciate. And so it's been great for allowing me to keep in touch with like a large number of people almost sort of passively. But most of those people never tell me that they're seeing my stuff. So it's always a little bit tricky to kind of evaluate the ROI.
Well, I'm sure in that instance too, if a founder's reading your writing after a first meeting, they're going to know, right, Nnamdi really understands the space. He would be a good thought partner on the board. And that goes a long way in eventually winning a deal when it gets competitive. I feel like founders definitely want to partner with investors that know their space and can provide value.
Yeah, totally agree.
Are there any other pieces of advice you would share with young investors looking to build a name for themselves in the industry?
It sounds cliche, but learn to think for yourself. Again, I think people say this and they don't actually mean it. I think it's important to actually mean it. I think one of the things you realize the longer you spend in this industry is everybody is making it up. Nobody knows what they're doing. All the people you think are brilliant and who have just figured it out, maybe they are brilliant. They may not have figured it out. The things that they have done just maybe happens to work, and maybe they did a better set of things than other people. But there's still a ton of uncertainty. I mean, it's been interesting watching investors who've been in this business for a long time struggle to kind of grok the last few years of crazy, market dynamics. This business is tricky for everybody on some level. And so don't feel that because you're new to the game or you're earlier in your career that means that you don't necessarily know what you're talking about. It's a hard industry to know what you're talking about no matter how long you've been in it. So just kind of like take that to heart and realize that like at the end of the day, what people care most about is it's going to be your track record at the end of the day. And so you have the opportunity to build just as good a track record as anybody else. So, just go out and do that.
One of the classic questions or debates is selection versus access. Where do you stand on that? Is it more about selection or is it more about access? Are you getting in front of the right startups?
Hard to disambiguate, but I can say from my perspective, access is a thing that I'm always willing to get more of, and more deal flow, more time with very strong founders, et cetera. That's the scarce resource in my mind. I find that when it comes to like evaluation, frankly, a lot of investors evaluate companies very similarly. It's actually quite hard to differentiate yourself in terms of your ability to evaluate companies for all sorts of reasons. And, once you are past a certain level of, I don't know if it's like IQ or like experience, but you know roughly what to look for. The question is like, can you even get in front of the people who have it? And more often than not. And so like, I know for me, especially, that's my big area of focus. It's how can I spend more time with, top 1% founders? Because once you're with that kind of individual, a lot of the questions just fall away and it actually becomes a very simple decision.
Yeah. You know it when you hear it. Any strategies you're willing to share on that front? How to get in front of the top 1% of founders?
This is cheating, but basically like, go to the top 1% people you already know and tell them who are the smartest people that you know. There's definitely these clusters of exceptional individuals and a lot of them know each other. So if you can kind of endear yourself with some of them and use that as a jumping off point for the rest of them, that can work. That can work well. But the 0 to 1 is tough for sure.
When you look back on your own career thus far, what have been some of your biggest misses? And from those misses, what have been your takeaways or insights that might change the way you approach investing?
This is cheating a little bit because it's not like a company that I missed or like some trend that I missed, but I still think I way underutilize the power of the cold email. And I send a lot of cold emails and I still don't think I'm using it enough. Just to be very transparent, like I tend to be too almost linear in my thinking as far as who should I be reaching out to and getting to know. Typically I'm trying to get to know founders or potential founders, but there's a lot of people out there who are not ever going to found something, who are also super thoughtful and relevant and well-connected and interesting people who I should be spending, time with. And a lot of these people will answer you if you just sort of send them a thoughtful note about, why you might have overlapping interests and whatnot. And so it's like a battle for me to tell myself every day that I should be reaching out to people. And oftentimes people you don't necessarily, for whatever biases you have, you don't necessarily perceive as being potential founders, end up founding something one day, and then you're kicking yourself that you never reached out to them. This has happened to me, very recently. And so I think that is something that, especially people who don't have a background in sales, I think greatly underappreciate. It's like the power of the cold email. And again, the kind of potential for upside. It's a relatively capped downside thing again. And so in any situation like that, you should like lean into it and do more of it rather than less. And so it's something that I could afford to be a bit better about. All sorts of good things have happened for me for the cold emails that I have sent. And so it's only worth doing more of.
So outside of founders, are there other groups that you're actively trying to spend more time with?
Yeah, there's actually one group of folks that are very relevant to the kinds of companies that I spend time with, which again are very kind of developer-centric companies. And these folks are, their titles can vary, but in general, it's called developer relations, which is sort of this go-between between what's happening in your company on the product and engineering side and your community that you're building around your tool or your product and whatnot. And developer relations folks are often very well networked. They're embedded in these communities. They're spending time with engineers and other technical people that understand their needs and pain points. They're tracking different trends and whatnot. They're very personable and they're technical themselves, which is like exactly the kind of node that you want to have in your network. And so I try and spend a lot of time, meeting these folks in my kind of general activities. And then my companies are always trying to hire developer relations people even very early on in the company's trajectory. And so I have that interest in it as well. But these are some of my favorite people to spend time with.
Yeah. I mean, they could be used for, potential talent, customers, diligence. If you're doing diligence on a startup, there's a lot of added benefit there for sure. Nnamdi, if we could feature anyone on the show, who should we interview and what topic would you like to hear them speak about?
I'm bad off the top of my head, but let me go with David Sachs. He is one of the, 4 musketeers on this podcast, All In podcast, which I'm totally obsessed with. And he and Craft Ventures are doing a lot of really interesting, work and deals over these last few years. And it's a relatively young fund, and I think they've made a name for themselves in a relatively short period of time, which I really admire. And so I think he'd be a great person to have on this podcast. He has both the VC and the founder experience, operator experience, what have you. So that's what I'd say.
Yeah, Craft is great. What resources have you found particularly valuable and would recommend to listeners?
This may not be new to most people, but I still tend to be obsessed with everything that Nassim Taleb has written, at least in book form. His Twitter is like a little crazy, but his books are amazing, and I totally swear by them. And I recommend them to everybody immediately upon being asked for book recommendations. So I think they've changed my viewpoint of the world and how I see things, and a lot of how I think about investing kind of is implicitly informed by those books. And so he's my go-to for sure.
Do you have any tools or hacks that are a secret weapon?
It relates to my point earlier about learning to just think for yourself, which is that I don't know whatever switch wasn't switched on in me as a kid, but I'm just much more willing to have a different opinion than other people as a general rule. And I'm not that convinced by whatever the zeitgeist or the common belief is at any given time. And if anything, the fact that so many people believe one thing tends to make me think that the truth has to be closer to the opposite, or at least in that direction. It's a very kind of markets-based view. It's like if everyone's buying into the stock is likely overvalued, that kind of thinking. I apply that to my life very, very broadly. And it's served me extremely well. It's like led me away from overhyped opportunities. It's helped me find diamonds in the rough, both companies and people. I have best friends who are my best friends today because I sort of bet on them when no one else wanted to. And that was the basis of our friendship. And so that's been a hack that has served me very well. And I continue to leverage it. Although it can make you feel a little bit like a weirdo in the short term, in the long run, you look very, very good.
It's interesting. Nnamdi, what do you know you need to get better at?
I am bad at asynchronous communication. I'm great at in-person communication. Like someone's just sitting right in front of me and we can talk. I'm pretty good at that, but great at like public speaking. I'm really bad at asynchronous communication. I put way too much effort into every word that I put on the page or in a text message or what have you. And it makes the exercise so draining that I end up just procrastinating on a lot of email and text messages, and people wonder if I'm just ignoring them. And I'm really not. It's actually, I'm trying to come up with like a thoughtful response, and I just way overthink it. And so I could definitely afford to be better about that.
And what's the best way for listeners to connect with you?
There's many ways. Twitter is great. Who is Nnamdi? My website is also whoisnnamdi.com. Feel free to send me a message on LinkedIn too. If you can find my email address, it's on the internet somewhere. I don't want to release it here, but you can find that, then I'll give you extra brownie points.
Awesome.
Thank you. Yeah, it was fun.
All right, that'll wrap up today's interview. If you enjoyed the episode or a previous one, let the guest know about it. Share your thoughts on social or shoot them an email. Let them know what particularly resonated with you. I can't tell you how much I appreciate that some of the smartest folks in venture are willing to take the time and share their insights with us. If you feel the same, a compliment goes a long way. Okay, that's a wrap for today. Until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks so much for listening.